All right, so I'm here with the famous Jake and Gino. What's up, guys? I appreciate you being on the show today.
How's it going, cowboy?
Brother, how you doing?
Do you guys have what 260 million in assets under management? I think close to 2,000 or more multifamily units. Gino, you started investing in 2002. Jake, you started in 2011. Obviously, you've compounded and grown, this huge portfolio and this huge portfolio you manage. And so I'd love to talk about how we got to that point, because I would imagine, I don't know the story, but you probably didn't start by buying 1,000 units at one time. So we'll start with you, Gino, because you started investing first, so you lead the way here. Why real estate for you? When did that happen?
So for me, I started out as the pizza guy. Jake was the drug rep, and I had a restaurant. I had one restaurant for almost 20 years, and I felt comfortable. But at a certain point in 2008, I'm like, I need to make more money. I had 4 kids at the time. I've got 6 children now. And the one restaurant gig wasn't working. And I just didn't know how to scale a restaurant. I wanted to have quality food. I had seen all the other players out there scaling businesses in the food industry, and I didn't want to be there. But to get back to that very first deal, I think the thing that separated us from a lot of other people becoming successful in real estate was our framework. My first deal was a 4-unit. Then from a 4-unit, I went to a mobile home park. Then from a mobile home park, I went to a strip center. Then from a strip center, I went to a mixed-use building. And then I said to myself, time out. This shiny object, I'm going all over the place. Let's focus on one asset class. And I chose multifamily. And then when I met Jake in 2009, we partnered up. He moved down to Knoxville in 2011. And we had already understood that our values aligned, our goals aligned. Let's start buying multifamily. That very first deal took us 18 months because we did not have a process or a framework. And after that first deal, we're like, okay, number 1, mom and pops. Number 2, buy right, manage right, and finance right. That second deal came 3 months after that first deal. And our third deal came 6 months after that. So I was flailing around for years with life before Jake. Jake pops up. I'm like, okay, you've got the right market now. I've taken mentorship. I've gotten education. I know how to figure this thing out as far as underwriting and deal flow. But if we didn't have that process after that first deal, it would have been very difficult to continue to scale and to continue to have success in the multifamily.
Wow. No, that's spot on. Systems and processes are everything. It can literally either make you or break you. And it sounds like you guys figured it out. How about you, Jake? Sounds like he said you were a drug rep. And at some point, I guess you said, screw this.
That out there because he knows how I feel about it.
What kind of drug rep? Because I was in pharmaceuticals, but some people do it legally, some illegally. So which side were you
I
on?
will say this. So I was in the pharmaceutical industry, and I can't say I'm super proud of it. I got some good corporate training, if you will. But I want to say this to all the folks out there for the sake of America. It's good when folks are looking into the pharmaceutical industry. It's good when they're being challenged. It's good when there's pushback going towards them. This quasi, business government thing they got going on now where Pfizer is basically the U.S. government is very dangerous. It's a very slippery slope. I don't support that, and it scares the shit out of me. So with that being said,
Agreed.
Folks, wake up. It's not a good thing. You got to be careful there. So I always preface it with that. I am not a supporter of what's going on these days where all of a sudden pharma and big government, big pharma are one institution. It's very dangerous for America. Okay, I think I made my point there. Now,
Love it.
After pharma started going downhill after the Sunshine Act, it scared the hell out of me. It stopped being fun. The culture went to crap. It started becoming like a government institution, which I just alluded to. And I realized I was no longer a good culture fit. So I needed to find somewhere else to go. I came in out of college. I thought I won the lotto, grew up on a dirt road in a very small town. So I was like, oh my goodness, I'm making 6 figures a year. I have a company car. I hit the jackpot. It went from good, great, whatever you want to say, to terrible. And I absolutely hated it. And every time there was a corporate event and we had to go away to the whatever city at the time, New Orleans, there was a catastrophe there. So they wanted to send everybody. I thought I was going to get fired for opening my mouth. They didn't want to hear from me. They didn't want to hear creativity. It was very dry and stale. So it was time for me to exit. I ended up going to Tennessee, and ultimately it fit my values. I was looking for a place with better weather. I was looking for a better tax situation and something that was pro-business. So anyone that wants to get into real estate, you got to select a market first. And unknowingly, I did that through just looking for quality of life. And, with quality of life came actually a really good emerging market to invest in. So that came next. And, as Gino said, I had him as a mentor. I had a doctor that was pushing me to start to invest in real estate. and I needed an exit, and real estate provided that for me. I was fortunate enough I was able to get out before they axed me, and landed on my feet with real estate. So that was the beginning of it for us.
I love it. Our stories are similar. I came out of college. I didn't come from money. My dad's a pastor. Pastors don't make any money unless you're one of these, I guess. Yeah, yeah, exactly. That's it. I did learn how to sell, but we weren't. He wasn't a prosperity preacher, so we didn't have the big tides coming in. Like some of these places do. But I got into pharmaceuticals, and I thought I was something. I mean, because growing up, it's like oh, they're a pharmaceutical.
Dude, that was the high.
You think you had made it. Oh yeah, I'm like, and I came in after the Sunshine.
Oh my
Act,
God,
so
you came into communism after it was communism. Holy shit.
Exactly. But I didn't know any better. So like it was still like I got to tell people I was a pharma rep, even though like I was driving a beat up.
You're a weather lady.
Had no money.
You were reading the script.
Cool. Yeah. But that's what it felt like. Every day was the same thing. It's like Monday I go to the same office, Tuesday same office.
Don't deviate
Dunkin'
from the
Donuts,
script, cowboy,
like,
or we're gonna slap your wrist. We're grading you. So.
That's exactly right. Which I will say, because I know coworkers listen to this, like former coworkers and bosses. It was like you said, there's fantastic. You learn stuff, so there's good and everything. I'm so thankful for the opportunity because it allowed me to get to where I am today.
You should have seen it before they went communist. It was great. So,
I mean, I've heard stories like it was not even the same industry, and they you literally can't give a doctor, for those listening, a pen with your company's name on it, or you can't give them anything. And like if you do a lunch, it's like an educational learning, and you have to write down everybody's name who was there. Like it's talk about write down the products you talked about. Nuts. It was crazy,
not fun, not a good place for humans to be.
No, not at all. But gave me my start, so I'll forever be grateful. But being able to leverage the W-2 to get into real estate was huge for me. And, it seems like you were able to do that a little bit too. So how did you guys link up? I personally have never heard your story, so I think it'd be cool to hear, how did you become Jake and Gino? Because obviously you've done a fantastic job. You're very well known now.
So for us, we just started out that I owned the restaurant and Jake was coming to get the food and bringing it to the doctor's offices. But Jake came in and he was ready to go. And he was young, he was hungry, and I knew that he wanted to get out and I wanted to get out. And we just decided, hey, let's start looking at multifamily. Up in New York, it didn't make sense. When he decided to leave Knoxville, I whip out the computer and I'm looking at LoopNet. I'm like, dude, there's some deals down here. When you get down there, situate yourself. Let's start looking at deals. So we start looking at deals, and within the first 6 months, his fiance moves down. So we have to take a pause and go, oh, can't buy any real estate now. Got to buy a house. So we stop. But I remember sitting in the basement of my house going, I am not quitting on this dream because I can't take New York anymore. I got to get the hell out of here. I'll figure anything out. We jump back on the horse. I would say within the next 12 months, we got that first deal. And then from there, just
it was quick. Yeah.
Well, was it quick? I don't remember the time, but I know it was 18 months from when you moved to Knoxville to when we bought that first deal. And it was a long time because we didn't know the process. We didn't know how to deal with brokers. We just didn't know valuations. And back then in 2012 and 13, there was a lot of deals. There was just no money. And the financing aspect of multifamily is coming back to where it's going to go right now in this part of the cycle. It was challenging. And we got lucky that we met a broker. His name is Rick Gentry. Big shout out to Rick. Big Ricky G. He helped us. Yeah, he was the one who found our first 4 or 5 deals, and he knew that we were both hungry. He knew that we were both young, and we just did what we said and said what we did on that first deal. 3 months later, Ricky brings us the second one. So that's the short end of it. It's just 2 guys who wanted to get together, who worked their asses off, who wanted something different, and who saw multifamily as that vehicle.
Went up too. I think that's key. Like we vertically integrated, so we're managing the properties ourselves, and then we didn't sell when valuations went up and tried to exit. So we've held everything. We did a couple syndications in the mix, and we sold those, but everything that we bought internally, which is 90% of our portfolio, we still own to this day. And that's really where you see the cash flow start to kick in. So sorry, what were you going to say?
No, that's a good point. Before I jump back to my other thing, when I've asked seasoned investors what's their number one piece of advice, they say don't sell. They say that's their biggest regret. Like, what's your biggest regret in real estate investing? Any property I've ever sold.
Imagine if you sold in 2019.
You'd be
you wouldn't be hurting, but you lost the run up. The inflation run up was nuts. So the rent increases were absolutely insane that we saw. So you would leave so much value on the table, and everyone thought the sky was falling and 2020 was the end of the world. So
Yeah.
So, Jaron, I would say not. I wouldn't say the selling is the big mistake. I think selling and not replacing is the biggest mistake. Because if you have a 12 unit, we're selling a small asset right now. If you're selling that small asset and not replacing with a bigger asset, that's where I think that people have problems. I think people sell, then they go party with that money. They don't reinvest it into their business and continue to grow. So, and not having that clear exit strategy. Because listen, everyone says you make money when you buy real estate. You really don't. You make money when you exit real estate, and we've made over 20 million bucks on our portfolio by exiting, by refinancing. That's where you make money when you crystallize the equity, and then actually putting that money into the next deal. That's how you really compound
I
your
love
wealth.
that. I mean, I know so many guys that live in a small town where, they'll be like, yeah, I got a rental property. I'm like, oh, how many you got? They're like, I got one, one or two. And they never
Mm-hmm.
compound, they never build upon that. And I feel like the wealth, as you guys have seen, is in the volume. The more that you can add to the portfolio,
Mm-hmm.
hold on over time or sell 1031 or whatever into a larger project, refi, pull capital back out. But it's hard to do that when you're not at scale. I learned that very early on. I bought 2 properties in 2018 and pretty much used all my capital. And I was like, okay, this is great. I feel good about myself. I've been a pharmaceutical rep, felt good about myself there. And now I'm a real estate investor. Like, I got 2 properties, but I quickly learned, like, if I was going to be something in this real estate space, like, 2 wasn't going to cut it. We either had to make a decision of, hey, we're not doing this or we're going all in. And we moved to add
Mm-hmm.
19 that second year to get to a total of 21 after the first 2 years of investing. And you let those, and we've added since, but you let that start to compound and not talk about the thousand, you get to the thousands of units like you guys have. A $25 rent increase on one property is 25 extra dollars a month. The $25 rent increase on 1,000 properties is, what is that? I guess
It's
25,000.
profit per unit times your scale. So
$25,000.
one metric that everybody
Exactly.
listening to this should be evaluating every month. This is the most important. We call it PPU. It's your profit per unit. You need to have a draw report, cash draw report every month, and you need to have your units and your unit types listed out next to it, and then your PPU, because you may see trends in your market where, hey, these 2-bedroom condos are yielding more than the 2-bedroom gardens. And there's a reason why, because people, whatever, want it upstairs, downstairs, or they want the washer dryer hookup. And then that can help you dial in your underwriting more when you're going for the next deal, because you see what's performing at a very high level in your market. And to your point, that PPU times your amount of units, that's going to be your total draw for the month. That's very important for people to look at. And a lot of folks we talk to don't look at profit per unit. It blows my mind. It's so important.
Yeah.
So
I love that. Yeah. Super informative. And I think that's, what's the word? What gets measured gets managed. Very corporate saying, but I feel as though, and I've had the tendency to do this in the past, is you don't really treat real estate investing like a job, or you just treat it as a hobby.
you
And
need
so
to
you
treat it as
really
the
kind of just,
business. This
exactly,
is what
like,
will
you should
set
know
you
all your
free. Yeah.
numbers.
This is not a hobby. You have a W-2. This is going to be something that'll set you free and pay you for the rest of your life. It's much more important.
Yeah, you got to know your crap. So, what has been your guys' business model? You'll link up in '09. What does that journey look like for you guys, and how has it progressed over time?
For us, so the first deal was a 25-unit deal. It was creatively financed. We had 10% seller financing. On the second deal, we met our partner, Mike, who's with us now since we started the journey, since that second deal. It was a 36-unit. Our third deal was 136 units. So you can see, think big, start small. And you just continue the process. And from then, we just went from 136 units on that third deal. We went back down to a 22-unit deal on our fourth deal. That 22 unit is such a profitable deal. Why would you go back down? Any deal that makes sense within our range, we're going to go after and take and put it on the contract. After that, our fifth deal was a 281 unit, 100% seller financed by the owner. It was 80% bank financed, 20% of the down payment was financed by the seller. So that was all seller financing. And then from there, we're at that 600 unit mark, and we didn't know how to scale. At that point, we had hit the wall and said, time out. How do we continue to add? And that's when we said to ourselves, we need to start some type of coaching or mentoring on scaling up a company, because at that point, I think Jake and I realized, wow, this really is a business.
Well, and I was so anti-corporate at that point too. I was like, anything that felt corporate, because
Mm,
I had been burned so bad by it in my head. I was like, stay away from it. So it was actually hurting our growth for sure.
And then, Jaron, as that was going on, we're refining properties, pulling out equity, buying the next deal, and then pulling it out and buying the next deal. So for us, I had worked 5 years. Like I said, Jake and I had met in 2011. In March of 2016, I left the restaurant and went into real estate full time. And Jake had done it about a year and a half sooner because he lived in Tennessee. His burn rate was like $1,000 a month. His mortgage was nothing. So his bills were a lot less than mine. I had 6 kids. He had no kids. So it was a lot easier for the Stenziano to leave the corporate job. But I think just our patience and the ability to pull the money out and to defer that gratitude and to continue to reinvest in these deals is what's allowed us to continue to scale. And for us, putting on the tool of syndication allowed us to buy a couple more deals using other people's money. And I think the overall theme of the show, as far as multifamily goes, is try to learn all the techniques. Don't be a one-trick pony where you're saying, I'm only going to do seller financing, or I'm only going to buy deals by myself, or I'm only going to syndicate. Learn all of those strategies because the market cycle changes. It evolves and it shifts from a buyer's market to a seller's market. Now we're going back to a buyer's market where we've already done one seller finance deal this year, and there are going to be some seller finance opportunities. It's been very difficult the last few years to do seller financing. Now we're having opportunities with the seller financing. So let's bring it out. Let's bring that tool back out. And syndication may be challenging in the next 6 months to 12 months because investors are a little skittish. If you're not getting money back from a deal, why are you going to put money into another deal? That's the reality. There's capital calls everywhere, and you may have a problem raising money.
I feel like a lot of guys just continually pivot. I remember for the longest time, Bitcoin was the rage. Then Bitcoin falls off, and self-storage has always been popping its head up, and industrial, and then there's the big multifamily push with bridge financing. We've done the same thing virtually since day one. We look for 20% top line revenue growth each year, and we stay in our lane, and we try to manage our properties very well. Vertically integrated, and it's the same thing. We set that number and we try to hit it every year, and that's essentially what we've done. We've brought our team members on board. We have over 70 people on our property management team. We allow them to invest with the company after they've been in it for 2 years, as long as they've been approved by their peers. There's no fees. There's no AC fees. There's no asset management fees. They get to invest dollar for dollar into their future. And we've had years where some folks have made more with their investments now than they have with their property management job. So it's very rewarding to see folks, build their wealth that way as part of our organization.
That's really cool. Yeah, I think to your point, it's good to keep the blinders on. So many people are chasing the shiny object, and it's sad because what happens when you do that is you actually take steps backwards instead of continuing forward. And if you would just make a decision on, like, you guys know the type of property you're buying.
Underwriting's like that these days. It's very quick. It comes in, we sift very quickly. There's our buying criteria, as we call it. We know it extremely well. And that's one of the things there's 2 things early investors screw up on: getting into too many markets and not having clear buying criteria.
Buy your first or next real estate deal in the next 90 days guaranteed, or we'll continue coaching you until you do. That's my guarantee if you join my rental academy. I've stumbled upon a process that is so powerful that I can sit here today and say, you can come into my world and buy your first deal in the first 90 days. And if you don't, I'm going to keep coaching you until you do. What we've done in the Rental Academy is we've removed all the roadblocks for you. I've already chosen the market for you. You're going to have leads generated automatically. Myself and my team's going to work with you to analyze those leads. When you pull the trigger on a property that you want to buy and you need to fund it, we've got lenders in place. And after you've closed on it, if you need to rehab it, great. We've got contractors in place. And if you want to keep it as a rental, we've got property managers in place. So you come into our world, we plug you into a proven system, make it easy for you so you can have success in your real estate investing journey. If you're interested, you can go to cowboysacademy.com, or if you go down to the show notes of this episode, click the link that says Cowboys Rental Academy, and it will take you to your next steps there. If you've been struggling finding good real estate deals, I've got a solution for you. It's REI Call Center. REI Call Center has professionally trained and managed cold callers to help you scale your real estate business. I think they give you somewhere around like 1,500 cold calls per day. Their clients have closed around $10 million from the leads they brought in. They got close to 200 clients going right now, and they're really more than just cold callers. Yes, they have their team of professionals who are making their calls, but they have weekly trainings and Q&A calls for yourself. They have training videos. They've got Slack channels with dedicated people to make sure you're successful. They've got checklists, cheat sheets, you name it. They've got you covered to make sure you are successful in your real estate journey. Well, how does it all work? Well, step one, you're going to pull a targeted list working with them from prop streams so that you can target the certain locations that you want to start buying properties in. Second, they're going to use their Zen call platform to start calling 1,500 calls a day per cold caller. They're going to then upload all the leads into Asana. You have a view of them, and you can go attack and start buying the properties that you see that pique your interest without having to do any other work. Look, I have worked a W-2 job while building my real estate portfolio. I've been raising a family the entire time, so I haven't had time to go and cold call myself. And that's where a company like REI Call Center comes into effect to be able to take that load off your plate so that you can generate leads, close more deals, and build that portfolio. You can reach out to them at reicallcenter.com, or if you go to the show notes of this episode, you will see a link that will take you directly to it.
Get dead set on your market and why you're there, and then what the criteria is that you're looking for. You're going to be able to communicate better with the brokers. You're going to be able to get deals off your desk quicker. The machine's going to run faster. It's going to be easier on you. And clarity sets you free as a multifamily entrepreneur. That's a big gap in folks' journey for sure.
I love that. And then on the flip side, once you know the type of property and your market you're going in, it's like Gino said, you got to be able to pivot with how you can buy. You know, we're all in the social media space. And if you're on the social media space, a lot of people niche down on how they buy particular properties. And so like students that I teach will come to me and ask me about a certain, way of doing something. And I'll say, if that makes sense for this market and this particular property, then yes, we should do it. But if it doesn't make sense, if it's not the most advantageous way to acquire it, then no, you don't do it just to say you do it or because it's popular at the time or popping its head up. And I think that's something a lot of people struggle with.
Not clear. Absolutely.
So do y'all, when you started, were you raising capital from the start, or was it just you three guys going out and getting creative and getting these big deals done?
It was just the three of us. But what happened with us is we found a really strong balance sheet partner, our partner, Mike. I mean, he was able to leverage his balance sheet on that third deal. He lent us some money as well because he saw the value in the deal. We brought tremendous value to him. He brought tremendous value to us. And I think the problem people don't understand is multifamily is a team sport. There's a lot of different jobs that team members and partners can play. And from that third deal, once we got it, we were able just to refinance money out, refinance equity out, and put it into the next deal. That was our strategy. Just
and like we said before, we did a couple syndications, realized that we're really comfortable in the buy and hold with our own capital model, and so we've stuck there ultimately.
Yeah, that's cool. So it hasn't been all syndications, but you've pulled that in.
Yeah, we did 3 and we still have one, but ultimately we just, I don't know, the last 10 deals or something we've done have all been just traditional buy and hold, cash injected from ourselves type of thing.
And I think, Jaron, the important thing is for anybody listening to this is what goals are you trying to achieve? If you're young and you don't have capital, well, you need to syndicate. That's the reality. The reality is you need to start raising capital for other deals. At one point, you're going to have enough capital to do deals on your own. That's great. Then you want to do deals on your own, and you can also use syndication as a tool. I think creative financing is a great way now to start getting into deals as well. But it really depends upon how much time you have, how much resources you have, and what your goals are. If you want to get to 10,000 units, probably not going to get there by yourself. You're probably going to have to syndicate. But if you want to buy 2 or 3 deals a year, I think you can do that on your own. I think really comes down to what you're trying to accomplish. And for Jake and myself, we buy 300 to 500 units a year, really good quality deals. We can fund that internally ourselves, and that's what we're looking to do. 300 units a year times $200 profit per unit. That's $60,000 a month in cash flow. Nothing wrong with that. I mean, and you're buying good quality deals that you can control. We're not outgrowing our infrastructure because we have to hire property managers. So that's one thing when you're vertically integrated, you just have to be mindful of your growth. You're adding more units on. Do you have the bandwidth to take those units on? Can you turn those units? Can you manage those units? It's really important to take a look from that perspective. And we just want to have something where we can control and we're pulling as much equity out of these deals as possible.
Good stuff. That's really, really good stuff. When you look at valuing a multifamily, I can hop online, value a single family home in 2 minutes, just off Zillow. There's obviously a difference in how you go about valuing these properties, and there's a lot of similarities as well. But would you talk to the audience and break that down? You don't have to get into the nuts and bolts of everything, but a high level view of maybe the differences between residential and these big commercial, and what are some key indicators that you're looking for?
Yeah, I can hit it, Gino. So again, we have 1,700 units currently in our portfolio. And what I will look to is properties that are near the subject property that we're looking to buy. So we're looking to buy a property, on the west side of town, whatever. I look to see what properties we have over there and the similarities between unit mix, et cetera. And then I'll determine what I believe the market rent is. And then I'll run basically a pro forma on what I think it can yield every month. And then we have, different fee percentages and everything. So I get a good idea of, okay, after 2 to 3 years, when this thing is stabilized, where do I think it can be? Okay. So that's what I'm going in. And then I want to see, and we have all the expense data because we run our portfolio now. So we're going to know what the expenses are. So it's creating that budget for us initially to see where we can go with that property, and then looking at what they're currently doing and trying to stress test it to say, are we missing something here? Is there not a washer dryer hookup? Is that why the rents are lower? Is there a management play? Why are they suppressed? Is the the property look drab when you pull in? We try to evaluate and flesh all these things out on the front end to see, are we just over assuming, or do we think we're spot on? And the really interesting thing too is if we're saying, okay, we can get to this point in 2 or 3 years. If you had a 3% rent growth on that, by the time you get to that 2 or 3 year mark, you're typically going to be higher than what you were projecting out anyways. So that's essentially how we're doing it. And then, we have various calculators at Jake and Gino that we use to analyze our properties. So we'll plug in the data, we'll look at it on actuals, and we'll look at it as, in terms of where we're going to be. We like to do loan to cost with credit unions or community banks on the front end. So if there's going to be a renovation, we're doing probably 80% loan to cost. That means the banks bring in a portion of the renovation to the table, and then we'll send it out to pasture, hopefully within 2 to 3 years to agency, either Fannie or Freddie. And we've done quite a few deals with those folks after we've gone in and kind of got the property to where we want it to be. We don't love going Fannie or Freddie on the front end because, again, we're buying from a lot of mom and pop type owners. Their financials are usually shit, and it's a struggle trying to pull teeth. And basically, we're looking at buying boxes. We're evaluating it, saying, where do we think this is once post renovation, and when we get there, especially when we're buying loan to cost. We do buy stabilized at times. That if we're doing that, we hope that the current ownership is sophisticated so that we can get reasonable financials if we're going to go to Fannie or Freddie on the front end. We bought. I think it was 2020, Gino. We bought about 90 or so units, something like that, with Fannie on the front end, and it was low 3% whatever rate. Made the deal work, and it's been fantastic since we've had it. We just brought the cash to the table for renovations on our end, so we didn't have to do that. So it varies, but that's typically how we're looking at evaluating our current data, seeing where we can get it to, and then looking for a cash on cash return. Not super concerned with cap rates and things like that. Again, we're saying, hey, what's the profit per unit of this asset going to yield every month? That's what's important to us.
Jared, the difference between, I think, residential commercial is in commercial, you're looking at the net operating income. You're looking at income over operating expenses, what that number is and where you can get that number. Right? You're buying on a pro forma. You're not buying on the broker's pro forma. You're buying on your pro forma. That's the important thing. And for us early on, thinking about, as an investor, what is your exit strategy? Because not every deal you're going to buy and hold forever. What are you looking to do with this deal? Are you looking to buy and to fix it and to flip it? Are you looking to buy, hold forever? Like Jake was talking about that deal. We can't refinance that deal because it has a 10-year term on it. But we bought it at such a good price point that thing is a cash machine. Now, if we'd done it differently, we probably could have done a step down. But a 3.5% interest rate for the next 6 or 7 years looks pretty freaking attractive. And rents were like $900 when we took over. They're like, yeah, I mean, the rents are $1,400 now. But I think looking at that, you're looking at your net operating income, and what you're trying to do in multifamily, you're trying to create some kind of valuation through operation. A lot of these mom and pops are operationally inefficient. They don't know how to run the properties. Their expenses are all over the place. They're not maximizing income. That's what you're trying to do in multifamily, because once you get your NOI up, your value goes up. And once that value goes up, you want to extract that value through a refi, loan to yourself, and put it in.
How do you feel comfortable knowing what that new value will be? Because you're buying undervalued properties that need value adds. You're putting refi into them. So let's say 2-3 years down the road, you're wanting to refi. When you're running your pro forma on the front end, how do you feel comfortable knowing what that guesstimate?
So it's not a guesstimate. Remember what I was saying before is that we look at our internal data. So we have 1,700 units in our market, when we know very, very clearly what the market rates are going to be within, say, $25 plus or minus. So we're very dialed in on where the rates.
Well, say if you're new though, if you have no current assets,
so
it's
just like that though. You run comps on. You go on. You pull a lot of comps. You can go on to apartments.com. I don't know what's that one we used the other Zumper, was it, Gino? And it gave you the average market rents for an area. I like to see comps though.
Yeah,
so
I mean,
you take a unit and what are they renting it for, and why, and how professional is the management if you happen to go that route.
So, Jaron, what I would also do is opt into all these brokers lists and start getting offering memorandums. And the OMs are going to tell you what the sales comps are. Well, this property at 150 units is a 1980s build, and it's sold for 130,000
You
a
don't want
unit. And
sales
usually
comps. You
they'll
want
tell
rent
you,
comps, though, I think, to his point, right? Yeah.
yeah, no, but what I'm saying is you're trying to see where the value is, where you can get your value to. Because yeah, where you can get the value to. And the rent comps is what you do. So if you're understanding, and for Jake and I, we keep it simple. We like the 1% rule. I mean, to be honest, if you can buy a property for $100,000 a door, and you're going to get around $1,000 a month in rents at interest rate, deal's probably going to work. And remember, we're buy right and sit tight. So we know $1,000 in rents today, 5 years from now, those rents are probably going to be $1,200 or $1,300. So if the deal works good today at a 7% interest rate or 6.75%, when rates go down, and they will go down, I don't care what anybody says, rates are going to have to go down because they're going to have to stimulate the economy. There's a new election coming up. You know, as you see right now, what's going on with real estate right now, things are seizing up right now. There is no one selling right now. Mortgages aren't being done. They need to stimulate the economy. So if you're buying at 6.75%, within the next 3 to 4 years, probably sooner, it's going to be back down to 4.5. So can you imagine if it's working at 6.75%? What's going to happen in 2 or 3 years when you're able to refi that baby out?
It's
let
going
it
to be
rain.
nice.
Two more things
ahead,
to Gino's point. You know, the second deal we bought, the rents were $350 on average, and now they're $1,100. So, you know, this is what you see happen over time. And, you know, going back to what you're looking for, we also look very strongly at the physical characteristics. We love townhomes. We love 2-bedroom units. We love 3-bedroom units. We love washer dryer hookups. We love 1980 builds or newer. We'd love to see PEX in there, you know, for the newer stuff.
You don't like copper? You guys don't like
sodium silicate, baby, right? Pump it. And also garages, and so you know it's the longevity. You know, your most expensive unit's your empty one, right? So we like the renewal. We like to get people staying in these homes and seeing the value. So
that's good stuff. You guys, I want to touch on a subject. I was actually talking about this on a previous podcast I was on, that you guys have said it over and over again, that I feel is a huge holdup for rookie investors. Don't just focus on year one pro formas. You got to know what the here and now is. You can't just buy a dumpster fire and not have a plan for it. But like you guys have said, even if year one's okay, like it's not a home run deal, it's a single.
people don't have the patience. The best thing that Gino and I have done is just buy right and sit tight, to his point earlier. And a lot of people get in, they're like, oh, this shit's not working, and then they're out within 16 months or something like that. And that's they're the biggest
Crazy.
enemy. So
it's crazy. I mean, I'll hear folks that I talk to, they will not buy a property because they have a certain number of cash flow they're looking for per month, and it'll miss it by $150 or something. I'm like, what? Like, you guys are missing out on hundreds of thousands of dollars, and then you will get that cash flow eventually, but you can't.
your evaluation should be done in 10-year blocks, right? Who said that, Gino?
Yes, good stuff.
Who was that, Linneman?
Yes, Dr. Peter Linneman, yes.
We had him on our podcast, and that's what he was saying. He said, look at your multifamily deals with 10-year blocks. You're going to have a weird year. Something goes wrong. Maybe you got pinholing in your copper pipes, and you got to fix them, whatever the case may be. Maybe there's a hailstorm. Over that 10-year period, though, you're going to look back, and in all the instances of us owning anything that we've owned for that period of time, we're very happy we've owned it, right? It's the long term. And I'll go back to that deal that was $350 to $1,100. Second year of owning it, dude, I fucking hated it. It was miserable, the shit that we were dealing with on that property. And I'm so glad we fought through it and we own it to this day. So happy. So if you're in the weeds right now and you're getting your ass kicked and you're taking the gut punches, fix the problem. Okay? You fix the problem. This game, real estate, multifamily, rewards those who solve problems. Fix it for the long term. Okay? You're going to see the results at some point. That's all I got to say about that.
Genius. I love it. I mean, that's spot on. There's nothing else to say other than don't just hear what he's saying, folks. Actually go and apply it.
Find the root cause and solve the root. Yes.
Well, that's where, people get lucky. Oh, you're lucky you bought in this time and this time. No, I took action. I got off the sideline, and then I just let time do it.
Nobody wanted the stuff we were buying when we were buying it. It was sitting on LoopNet, okay? That was the graveyard for deals, and that's where we scooped up our first probably – 500, 600 units, something like that. Yeah.
5.
And I'm sure everybody told you it was a terrible time to buy real estate.
Gino couldn't even tell his mom about it. He didn't tell his mom. What, did you have 500 units before you told mommy there or what?
No, I had 212 units, and I said, "Mom, I'm leaving the restaurant in about a year or so," and she was flabbergasted. And I think that's the point right now that we're at right now, that everyone's saying real estate's risky, and you're seeing all these another day, another capital call, another Ponzi scheme, another thing going wrong. And for those of us in the business, we're like, finally. It's happening. Now the deals are coming. And I think that you have to understand it's only the right time when you're ready. It's only the right time when you have a process. It's only the right time when you have a business plan. It's only the right time when you have capital lined up. I mean, that's when you're ready, you're ready. I was not ready in 2011, other than I was ready mentally. And I was just sick and tired of doing the same damn thing over and over again, getting the same results, thinking I was going to get different results. So if you're ready to invest in real estate, now, sincerely, is probably the best time in the last 7 or 8 years to get into the market, because we're seeing that shift. Asset prices are coming down. There are less people in the market right now bidding up assets because they're afraid. People have left because they're afraid, and people have left because they've got capital calls and they can't buy another deal because they've got 3 dumpster fires, so they can't take on another deal. And that's the reality that's going on. And on top of that, this the finance cowboy, it's a lot harder to finance deals right now as well. So it's harder to bring. You need to bring more capital to some of these deals. So there are opportunities right now, and it's only going to get better.
What does that look like for you guys in this high interest rate
We're
environment?
active, man. We're buying so much more than we have in the last few years. We've closed on 2 deals already. We've been working on some other ones here as well. And so, the last few years we were piecing together what we could find because everything was getting bid up. We were having to go direct to seller. We're doing maybe 100, 200 units a year. We have bandwidth for more than that. I mean, I don't know, a little over 225 that we've closed on so far this year, 2 deals, and we have other stuff in the hopper and seeing more stuff hit the market now than in a long time. So we're ready to go.
I think, Jaron, to your point though, interest rates, if the cost of capital is higher, prices got to come down. And that's what's happening. They didn't have to come down 2 years ago because everyone was being risky and doing bridge debt. We want long-term fixed rate financing. So people were taking a gamble on you know what? I can overpay because debt is cheap. Well, you can overpay if debt is cheap if you have a time horizon. But when you have to get things done in 2 years or 3 years, and you have supply chain issues and you have maintenance issues and there's not enough labor and you can't get that deal to work, and then all of a sudden, rents decide to stop growing, you get into a big, big hassle. So right now we're basically underwriting at 6.5%. If it doesn't make sense, then you pass on the deal. Those who have to sell right now are going to have some problems. You can always buy real estate in any part of the cycle. You can't always sell it. And that's where we're getting at right now. You can't always sell it. It's going to be a lot more challenging to sell for the price you want to get. You're looking at last year. If you go to your broker and go, hey, you offered me 110 a door last year. Nope. You ain't getting 110 a door this year.
I'm big in the residential space, dude. You're not getting what you want anymore. And
I'm getting what I want because I want to buy.
Well, I'm talking about on the seller side. On the seller side, you're screwed.
We were getting so bid out in the last few years because we wouldn't do bridge debt, and everyone's kicking our ass with bridge debt. We're like, we're not doing it. We just
smart.
It's not part of our finance rate.
We're looking at each other going, what are we doing wrong?
We weren't willing to gamble like the other folks, so that's the difference. Yeah.
Yes. Well, that's how when you talk to people who got burned, they were carrying bridge debt on from my experience on a lot of different properties.
1 or 2 things gone wrong. The rents didn't go up like they thought. Taxes went up unexpectedly, and they, for whatever, insurance hit them, in Texas or whatever. These are the stories that you're hearing, and it's like you ran your numbers too damn tight. I mean, you just
just don't do that. That's it.
Be okay.
You have to be able to walk away. You got to be able to walk away.
And the deals that we haven't done were the best deals that we've ever done, because you get one bad one in the mix, it sucks up so much of your time and bandwidth. So it's not going to allow you to grow, and it's going to be miserable. You want to enjoy your life, And
it goes back to the patience. I mean, you guys work with a lot of people. I have the opportunity to work with a lot of people, and the biggest thing that I see is folks get very impatient. I was talking to a student the other day. They've literally been looking in a market for a week and a half, and they messaged me and they said, I posted a deal that I just did. I've been working this market for 6 years, the same deal that I just did, but they're like, bro, you got to help me. I'm not able to get a deal done.
People think it's like shopping at Walmart. This is not. You don't go into Walmart and get the socks off the rack. You don't get the milk out of the fridge. No. You got to work and create relationships, and people need to know that you're able to close. If you go to a broker and tell them you want to buy 100 units, they're going to, and you've never done a deal before, you don't have financing lined up, you don't have the capital, why are they going to waste their time with you? You have to realize what the situation is. This is not Walmart shopping. This takes time. This is going to take a year or two to get going if you want to do it at a high level.
Jaron, I made the observation to Jake when we first started. It's like you're going to college. It took us 18 months to find that first deal. So we were sophomores in college on that first deal. But by the time sophomore year ended, we had 200 units. And by the time we graduated college at 4 years, we had 600 units. And most people just get out and start working, but they go get their master's. So at 6 years, we had over 1,000 units. So if you want to look at it from that perspective, it's not that long.
No.
4 years is not a long time. Most of us barely graduate college after 4 years.
Don't go to college and just start investing. That's the message here.
Yeah, I mean that's pretty good.
Be
pretty
24
good
years
right
old
there.
and shit rich.
Yeah. In fact, let me go back and try that. I would love to. I had fun at college, so I don't know. It's a toss up there. But no, there's time. It takes time, and I think that's big. Yeah, exactly. That's exactly what it was. I came out with like 65 grand in student loan debt, and just to be stupid and play baseball. I'm like, it was fun, but was it that fun? So, well, guys, thank y'all for coming on. This was fantastic. Y'all are great personalities. You are obviously fantastic real estate investors, and I appreciate you sharing your time with our listeners. Where can everybody find you at?
JakeandGino.com. That's the hub for everything. We've got blogs, we've got podcasts. We do the Jake and Gino channel. We do a how-to. I've got the Movers and Shakers show that we highlight our students closing deals. Listen, our students have closed over 70,000 units. They've raised over $400 million. It's really about buy right, manage right, and finance right. We didn't have the framework until we had it, and I had made so many mistakes before I met Jake. So find the framework, find the process, find the community that fits your goals. And if you're looking to get into multifamily, whether you have a couple of units or you have 200 and want to scale, just reach out to us at jakeandgino.com.
Love it. Guys, thank you so much for being on. This is fantastic. To the listeners, take a screenshot. If you're listening to this on podcast or watching on YouTube, tag us on social media and on your Instagram story, whatever. We'd all three like to tell you thank you for taking time out of your day to listen to the show. And Jake and Gino, you guys are awesome. Appreciate it. And I look forward to being on your guys' show very soon.